Good day guys, it's Manny here, and in this video we'll be talking about smart passive income ideas. We'll talk about 20 easy tips and the risk involved with those ideas. So let's get started. So what is passive income? Passive income includes regular earnings from a source other than the employer or a contractor. Many people think that passive income is about getting something for nothing, which is not true. It still involves work. You just give the work upfront and then you'll be rewarded. In practice, you may do some or all of the work upfront, but passive income often involves some additional labor along the way too. You may have to keep your product updated or your rental property well maintained in order to keep the passive income coming. But if you're committed to this strategy, it can be a great way to generate income and you will create some extra financial security for yourself along the way. Passive income is about creating a consistent stream of income without you having to do a lot of work to get it. So if you're thinking about creating a passive income stream, check out these smart 20 strategies and learn what it takes to be successful with them. Number 1, flip retail products. Take advantage of online sales platforms such as Amazon or eBay and sell products that you find at a cut rate prices elsewhere. You will pocket the difference in your purchase and sale prices and may be able to build a following of individuals who track your deals. Risks involved with this strategy will be like while sales can happen at any time online, helping make this strategy passive, you will definitely have to hustle to find a reliable source of products. Plus, you will have to invest money in all of your products until they do sell. So you need a robust source of cash. You'll have to know the market so that you are not buying at the prices that are too high. Otherwise, you may end up with products that no one wants or whose prices have to drastically cut down in order to sell. Number 2, buy crowdfunded real estate. If you're interested in investing in real estate but don't want to do a lot of heavy lifting like management, repairs, handling tenants, and more, then another option is using a crowdfunding platform to invest in property. An experienced investing team picks out the real estate and then you can decide to invest in it and how much you are comfortable with. You will pay an annual management fee to the real estate funding platforms. So while past results may look good, they are no predictor of the future success. And you will have to make the judgment call about what to buy. That means you will need to read the prospectus for every deal you are interested in and understand the pros and cons. In addition, real estate is typically funded with high levels of debt financing, making it more susceptible to any economic downturn. You will also want to understand how long your money will be locked up in the investment and when you can access it, especially in an emergency. Number 3, create a course. One popular strategy for passive income is creating an audio or video course, then kicking back while cash rolls in from the sale of your product. Courses can be distributed and sold through sites such as Skillshare. Alternatively, you may consider a freemium model, building up a following with the free content and then charging for more detailed information. For example, language teachers and stock picking advice may use this model. Now, the free content acts as a demonstration of your expertise and may attract those who are looking to go to the next level. The course can deliver an excellent income stream because you make money easily after the initial outlay of time. Now, the risk involved in that is it takes massive amount of effort to create the product, and to make good money from it, it has to be great. There's no room for the trash out there, and one product alone is not a business model unless you get really lucky. The best way to sell an existing product is to create more excellent products. Once you master this business model, you can generate a really good income stream. Number 4 is the more popular one, affiliate marketing. With affiliate marketing, website owners, social media influencers, or bloggers promote a third party's product by including a link to the product on their social media account. Amazon might be the most popular, and Instagram and TikTok have become huge platforms for those looking to grow a following and promote products. You can also consider growing an email list to draw attention to your blog or otherwise direct people to products and services that they might want. So when the visitor clicks on the link and make a purchase from the third party affiliate, the site owner or a blog owner earns a commission. The commission might range from 3 to 7% or even 10%. So it will likely take significant traffic to your site to generate serious income. But if you can grow your following or have a more lucrative niches such as software, financial services, or you might be able to make some serious goal. So the risks involved with the affiliate marketing is if you are just starting out, you will have to take time to create content and then build on that traffic. It can take significant time to build the following as well. And you'll have to find the right formula for attracting that audience, a process that itself might take a while. Worse, once you have spent all that energy, your audience may be apt to flee to the next popular influencer or a trend or a social media. Number 5, rental income. Investing in rental properties is an effective way to earn passive income, but it often requires more work than what people expect. If you don't take the time to learn how to make it a profitable venture, you could lose a lot of your profits. So to earn passive income from the rental properties, you must consider 3 things. How much return do you want from the investment? The property's total cost and expenses? The financial risks of owning the property. For example, if your goal is to earn $10,000 a year in rental cash flow, and the property has a monthly mortgage of $2,000 and costs another $300 a month for taxes and other expenses, you would have to charge $3,133 in monthly rent to reach your goal. Now, the risk involved in this strategy is there are few questions to consider yourself. Is there a market for your property? What if your tenants who pay late or damage the property? What if you are unable to rent out your property? Any of these factors could put a big dent on your passive income. An economic downturn can pose challenges too. You may suddenly have tenants who can no longer pay their rent, while you may still have a mortgage of your own to pay, or you may not be able to rent the home out for as much as you could before as incomes decline. And home prices have been rising quickly due to part to relatively low mortgage rates, so your rents may not be able to cover your expenses. So you'll want to weigh these small risks and have contingency plan in place to protect you. Number 6, writing an ebook. Writing an ebook can be a good opportunity to take advantage of a low cost of publishing and even leverage the worldwide distribution of Amazon to get your book seen by potentially millions of would-be buyers. Ebooks can be relatively short, perhaps 30 to 50 pages, and can relatively cheap to create since they rely on your own expertise. You will need to be an expert on the specific topic, but the topic could be niche and use some specific skills or abilities that very few offer. You can quickly design the book on an online platform and then even test markets with different titles and price points. But just like this designing a course, a lot of value comes when you add more ebooks to the mix, drawing in more customers to your content. An ebook can function not only to deliver good information and values to the readers, but also as a way to drive traffic to your other offerings, including audio or video course. Now, the risk involved in that one is your ebook has to be very strong to build up a following, and then it helps if you have some way to market it, such as an existing website, a promotion on other relevant websites, appearances in the media or podcasts or something else. So you could put in a lot of work upfront and get very little back for your efforts, especially at first. It will help if you write more and then even build a business around the book, or make the book just one part of your business that strengthens the other parts. So your biggest risk is probably that you waste your time with very little rewards. Number 7, sell photography on. So selling photography online might not be the most obvious place to set up the passive business, but it could allow you to scale your efforts, especially if you can sell the same photo over and over again. To get started, you will have to be approved by the platform, and then you license your photos to be used by whoever downloads them. Now, the risk involved with that strategy is you could add hundreds of photos to a platform such as Getty Images and not have any of them really generate meaningful sales. Only a few photos may drive all of your revenue, so you have to keep adding photos as you search that needle in the haystack. Number 8 is peer-to-peer lending. So a peer-to-peer loan is a personal loan made between you and a borrower, facilitating through a third party such as a Prosper or a lending club. Other players include Funding Circle, which targets businesses and has higher borrowing limits, and Payoff, which targets better credit risks. So as a lender, you earn income via interest payments made on those loans, but because the loan is unsecured, you could end up with nothing in the event of a default. So to cut that risk, you can do two things. Diversify your lending portfolio by investing small amounts over multiple loans. At Prosper.com and Lending Club, the minimum investment per loan is $25. And the second thing you can do is analyze historical data on the prospective borrowers to make informed picks. Now, the risk involved is it takes time to master the metrics of peer-to-peer lending, so it's not entirely passive, and you will want to carefully vet your prospective borrowers. Since you are investing in multiple loans, you must pay close attention to payments received. Whatever you make an interest should be reinvested if you want to build a continuous, consistent income. So number 9 is dividend stocks. So shareholders in companies with dividend yielding stocks receive a payment at regular intervals from the company. Companies pay cash dividends on a quarterly basis out of their profits, and all you need to do is own that stock. Dividends are paid per share of stock, so the more shares you own, the higher is your payout. Since the income from the stock isn't related to any activity other than the initial financial investment, owning dividend yield stocks can be one of the most passive forms of making money. The money will simply be deposited in your brokerage account, but the risk involved is the tricky part of choosing the right stocks. For example, companies issuing a very high dividend may not be able to sustain it for the longer duration of the times. So you have got to investigate each company's website and be comfortable with their financial statements. You should spend 2 to 3 weeks investing on each company you are invested in. So you can also go with the exchange traded funds, also called ETFs. ETFs are investment funds that hold assets such as stocks, commodities, and bonds, and they trade similar to stocks. ETFs also diversify your holdings, so if one company cut its payout, it doesn't affect the ETF's price or dividends too much. ETFs are the ideal choice for novices because they are easy to understand, highly liquid, inexpensive, and have far better potential returns because of far lower cost than the mutual funds. Another key risk is that stocks or ETFs can move down significantly in short periods of time, especially during times of uncertainty, as it happened in the March of 2020 and in the recession of 2008. When the coronavirus hits in the 2020 and in the 2008 there was major recession that put all the stocks down. Economic stress can also cause some companies to cut their dividends entirely, while diversified funds may feel less of the pinch. So the best strategy is to stay invested and keep dollar cost average. So number 10 is creating an app. Creating an app could be a way to make that upfront investment of time and then reap the rewards over the long haul. Your app might be a game or one of that helps mobile users perform some hard to do function. Once your app is public, users download it and you can generate income. An app can be a huge upside if you can design something that catches the fancy of your audience. However, the biggest risk here is probably that you could use your time unprofitably. If you commit little or no money to the project, or money that you would have spent anyway, for example, on a hardware or in software, you have little financial downside here. However, it's a crowded market and truly successful apps must offer a compelling value or experience to users. You will also want to make sure that if your app collects any data, that it's compliance with the privacy laws which differ across the globe. The popularity of the apps can be short-lived too, meaning your cash flow could dry up a lot faster. Number 11, rent out a parking space. Do you have a parking space that you're not using or that you could be used by someone else? Just write in the comments below if you do have that one. You could trade that spot for some cash, and it could be an even better setup if you have a larger area that could fit several cars or that could be useful for multiple events or venues. In particularly high demand areas or during high demand times, your parking spot could be worth really good money. For example, if you live near a place that has a frequent commuters but that is strapped for parking spots, you might have a money maker on your hands. You might have the best chance of turning a profit by renting to someone who needs the spot on a daily basis rather than for one-off events. Now the risk involved in that one is the idea might not be particularly that risky, but you do want to make sure you aren't violating any restrictions from the place of residence or other entities by renting out a parking space. It's probably worthwhile having a disclaimer of liability as a condition of parking in your spot. Number 12, REET. A REET is a real estate investment trust, which is a fancy name for a company that owns and manages real estate. Have a specific legal structure so that they pay little or no corporate income tax if they pass along most of their income to shareholders. You can purchase REET on the stock market just like any other company or dividend stocks. You will earn whatever the REET pays out as a dividend, and the best REITs have a record of increasing their dividends on the annual basis. So you could have a growing stream of dividend over time. Like dividend stocks, individual REITs can be riskier than own ETF consisting of dozens of REIT stocks. A fund provides immediate diversification and is usually a lot safer than buying individual stocks. Now the risk involved in this one is just like dividend stocks, you have to be able to pick the good REITs, and that means you will need to analyze each of the businesses that you might want, which is a time-consuming process, right? And while it's a passive activity, you can lose a lot of money if you don't know what you're doing. Like any stock, the price can fluctuate a lot in the short term. So REIT dividends are not protected from tough economic times either. If the REIT doesn't generate enough income, it will likely have to cut its dividend or eliminate it entirely. So your passive income may get hit just when you want it the most. Number 13, a bond ladder. A bond ladder is a series of bonds that mature at different times over a period of years. Thus, a bond ladder is a classic passive investment that has appealed to retirees and near retirees for decades. You can sit back and collect your interest payments, and when the bond matures, you extend the ladder again. A bond ladder eliminates one of the major risks of buying bonds. The risk that when your bond matures, you have to buy a new bond when interest rates might not be favorable. Bonds come up with other risks too. While treasury bonds are backed up with the federal government, corporation bonds are not. So you could lose your principal if the company defaults. And you will want to own many bonds to diversify your risk and eliminate the risk of any single bond hurting your overall portfolio. And because of these concerns, many investors turn to bond ETFs, which provide a diversified fund of bond that you may set up. Number 14, sponsored posts on social media. Do you have a strong following on social media such as Instagram or TikTok? Just write in the comments below and let me know how many followers do you have in your Instagram or TikTok. So get growing consumer brands to pay you to post about their products or otherwise feature it in your feed. You will need to keep filling your profile with content that draws in your audience, and that means continuing to create posts that grow your reach and engage your followers on social media. Leveraging your social media presence is an attractive business model. Draw eyeballs and clicks on your profile with strong content and then monetize your content by setting up sponsored posts from brands that appeal to your followers. So the risk involved in here is getting started here can be a catch-22. You need a large audience to get meaningful sponsored posts, but you are not an attractive option until you get a meaningful audience. So you will have to focus a lot on the first time on growing your audience with no guarantee that you will be successful. You can end up spending tons of time following the trends and building content in the hopes that you eventually get the sponsorship that you are aiming for. Even when you got the sponsored post you are looking for, you will need to get posting to draw in your audience and remain an attractive option for advertiser. That means committing to more time and monetary investment, even if you do have a lot of autonomy on exactly when to do it. Number 15, investing in high yield CD or FD or savings account. Investing in high yield certificate of deposit CD or fixed deposit FD or savings account at an online bank can allow you to generate a passive income and also get one of the highest interest rates in your country. You won't even have to leave your house to make money. And this type of investment is the most risk-free as well. The only risk involved is as long as your bank is backed by the FDIC and have some kind of insurance and is within the limits, your principal is safe. Number 16, Airbnb. This straightforward strategy takes advantage of space that you're not using anyway and turns it into a money-making opportunity. If you're going away for the summer or have to be out of the town for a while, or maybe even just want to travel, consider renting your current space while you're gone. You can list your space to any number of websites such as Airbnb and set the rental terms yourself. The risk involved here is letting strangers stay in your house and they may deface or even destroy your property or even steal valuables. Number 17, advertise on your vehicle. You may be able to earn some extra income by simply driving your vehicle around the town. Contact a specified advertising agencies which will evaluate your driving habits, including where you drive and how many miles. If you are a match with one of their advertisers, the agency will wrap your car with an ad at no cost to you. Agencies are looking for newer cars and drivers should have a clean driving record. Now the risk involved is, if this idea looks interesting to you, be extra careful to find a legitimate operation to partner with. Many frauds set up scam in this space to try and milk you out for a few thousands. Number 18, create a blog or a YouTube channel. Are you an expert on travel to Thailand, or you're into gaming of Minecraft or a sultan of swing dancing? Take your passion to the next stage by just putting a blog out there or a YouTube channel. So using ads or sponsors to generate that extra income. So take your passion to the next level for that subject and turn it into a blog or a YouTube channel using ads or sponsors to generate that extra income for yourself. Find a popular subject, even a small niche, and become an expert on it. At first, you will have to build out a suite of content and draw an audience, but it can create a steady income stream over time as you become known for your engaging content. You can leverage a free platform and then use your great content to build a following. The more unique your voice or area of interest is, the better for you to become the person to follow. Then draw sponsors to you. The risk involved is you have to build out your content at the start and then create ongoing content, which can take time. And you will need to be really passionate about the product, since that can help you maintain the motivation to continue, especially at the start of your followers are still finding you. The real downside here is that you can outlay a bunch of your time and resources with little to show up. Number 19, starting a business of renting out useful household items. Now here's a variation for that one. There's an ideal car sitting in your house and you can rent that one. Even a smaller with other household items that people may need, but they may be collecting dust in your garage, like lawnmowers or power tools or mechanical tools and a toolbox, tent or larger coolers. Look for higher value items that people need for a short period of time. and where it might not make sense for someone to own the whole item by itself. Then put together a way of clients to discover your inventory and a way for them to pay for it. Now the risk involved in that one is there's always a possibility that your property can be damaged or stolen, but you can mitigate the risk with contracts that allow you to replace the item at the client's expense. You can get a little bit of bond in upfront to get that expense done for you. If you start small here, you are not exposed to much risk either, especially if you already have the item and you are not likely to need it. Number 20, sell designs online. If you have a design skill, you may be able to turn them into a moneymaker by selling items with your printed design on them. Businesses such as Cafe Press and Zally allow you to sell items such as t-shirts, hats, mugs, and more with your own design. You can start with your own designs and see what the market is interested in and expand from there on. You may be able to capitalize on surging interests in a current event and design a shirt that captures the spirit of the times, or at least a snarky take on it. And you can also set up your own web storefront through the sites such as Shopify to market your goodies. You can also go in the designing of the logos and the designing of the websites if you're skilled enough to do so. The risk involved is printing partners allow you to ship items without directly investing into the merchandise yourself, avoiding one of the biggest risks of tying up your capital. But you may be able to get better prices if you invest in some of the inventories yourself. Another bigger risk is that you could invest a lot of time with very little payoffs. But this avenue might be interesting if you're already doing the design work for another purpose, such as personal interest. I hope you liked the video, and if you really consider just giving me a thumbs up, that would be great for the YouTube algorithm, and you can just spread the word around if you really like the work I have done. If you get a little bit out of that video, just leave the comment underneath the video. That would mean a lot to me. That would mean a lot to the YouTube algorithm. Thank you so much for watching.